All right, so I'm going to do a quick intro of both of our speakers, and then we will get to the presentation. A few housekeeping things. You're welcome to exit to go out, get some extra coffee or breakfast. If you are not staying for the legal roundtable, we do ask you to exit campus at the conclusion of the workshop because we do have a class in session today along with a few other events happening. So you will notice a lot of activity here. So. Our two presenters are David Mess and Ben Orthlieb, both Wharton MBA alumni. And I'm going to read a quick bio so we all know who's speaking today. So David is a seasoned private equity investor and venture capital investor, consistently outperforming across investment stages, industries, and geographies. David is the founder and managing partner of the secondary direct VC firm ARC Venture Partners, and also the founding partner at the angel investment firm Off the Grid Ventures, and also one of the co-founders of the Wharton Alumni Angels of Silicon Valley. So lots of different things going on. Ben Orthlieb has over a decade of experience in technology and media, information technology, and strategic planning for cloud, internet technology, and traditional media industries. He currently runs business operations for LinkedIn Marketing Solutions, is also a founding partner at Off the Grid Ventures, and also a co-founder of the Wharton Alumni Angels of Silicon Valley. So thank you very much, Ben and David.
As we set up, thank you for being here. I was just reflecting this morning. I'm about to go to my 10-year reunion, so it's actually really, really cool for me to teach a class again. I haven't done this since I was a TA 10 years ago, so thank you. It's really awesome. The whole point is give you sort of our top of mind sort of thoughts for angel investing. So make it interactive. I think the presentation itself is about half an hour. There's time for Q&A at the end, but don't hesitate to stop us with questions, and we can either answer in the flow or park them. But the whole point is to get your guys' question, your input, and so make it more of a conversation than just a dry presentation. All right? With that, we're going to reintroduce ourselves.
Well, I think Jill covered it well. Thanks a lot for that. I think what we should probably do. So I've been doing venture capital for a long time. I've been at the early stages in the beginning of my career. At later stages now doing secondary direct, but I was missing the early stage excitement. That's why I got back to angel investing. Did it alone at first, then joined with Ben and a few other friends, and ultimately we created a small firm called Off the Grid Ventures for reasons you'll probably understand as we go through this presentation, but it's more fun to do it with groups, and it's more fun to do it in a structured way such that you can also ensure you deliver returns over the long run.
Ben Orthlieb, I think the one thing that I wanted to share with you is I'm probably in the same seat as many of you 2 or 3 years ago when I did a couple of investment really to help business school friends that were starting their company. I signed docs. I had no idea what I was doing. But I was like, hey, I like you, and it's my way of like saying that I like you and supporting you. And then that grew into, okay, well, this whole angel thing seems interesting, and now we've done, I think we just added 2 more this week, so we're at 17 deals together, and so there's a learning curve that we're trying to share here, but the whole point is, from nothing 2 to 3 years ago to 17 deals, that actually takes a little bit of work, quite a bit of work. But if you're wondering about can you do this, you definitely can. I mean, I had no clue 2 or 3 years ago, so hopefully that gives you more of an idea that it is doable for a lot of people. It's fun. Why are you interested in doing angel investing? Like, you guys are here thinking about this. What comes top of mind when you're saying, oh, should I be pursuing this, or maybe I'm already pursuing this? What are the key attributes of angel investing in your mind?
For me, it's kind of an inefficient asset class. So, potentially, if you can get with the right people, you make that sense returns.
Yep. Pay it forward. People that took a chance on our company want to take chances on others.
That's right. Yeah, there's lots of ex-entrepreneurs that we need to read.
Thank you.
And diversify my investments.
Yeah, very correlated.
All right, it's the morning, so. These are the ones we usually hear about. We've talked about, financial giving back, financial returns. It's really, there's also some of the elements around it's a nice environment to be in. Like, it's really fun. It sort of escapes from fake news, but really it's just like I spend about an hour a day on this, and it's like it's really sometimes it's at night, but it's something that's still motivating enough and fun enough that I actually want to do it. So I want to share this. It's both financially rewarding. It has pay forward attributes, and it's sort of a fun environment and fun conversation to be part of.
Whatever your reasons to do it, though, whatever the key driver is, you should always do it for returns. Otherwise, it's as if you were playing soccer, not trying to score a goal. It makes absolutely no sense, and you're not going to do it well. If you look at historical returns, you can see that over the long run, if you do this well, you're going to get better returns than anything else, pretty much. Stock market, certainly bond market, and a lot of other categories. The reasons for that are really pretty simple. You don't need to have a Wharton finance degree to understand it. The first reason is it's easier to grow something small than something big, right? So if you're looking for growth as a way to generate returns, well, it's better to invest in a mid-cap than a large-cap company. It's better to invest in a small-cap than a mid-cap, and it's even easier to invest in a startup because you start from zero. And so just from the revenue growth, you can get somewhere. The second reason is a lot of these startups are based on technology, and technology is, of course, a major driver of high growth, but it's also a major driver of strong margins if you do it well. And so for these reasons, you can generate superior returns. Of course, there's a lot of risk associated to that, but we'll get into it and see why and how you should do it.
And the additional things that I come from, it doesn't say on my resume, but actually I'm a finance geek, and so I read a lot of academic papers. I've done tons of trading schemes, simulations. One thing that I started to think about when I got into Angel is the whole point around the diversification. I mean, it is really a different asset class that actually, somebody said it's inefficient, and it totally is. And so I think there's a benefit to your portfolio, as you were saying earlier, to have some of your money in Angel in general, once you have sort of enough money aside, because that will be both a portfolio boost, but also a portfolio diversificator. And the one thing that I was reflecting on is, for people who trade stocks, I mean, you see all the studies that are done on people managing their own money. They sell at the wrong time, they buy at the wrong time. Like, the whole behavioral bias is horrible because you've got information on a daily basis about what your companies are worth, and you can trade on a daily basis. Well, illiquid asset classes take that away. So in many ways, you have to stick it out with your investments. And also, one of the key drivers of returns is actually sort of momentum in a not day-by-day momentum type of a way, but it's like you're going to lose money on the companies that are not performing, and there's nothing you can do about it. You can't cut your losses, but you can ride your winners. And we're going to talk about this, but having the ability to keep on investing on sort of those few companies that are going to really outperform in your portfolio is a key driver of returns. And so those two things, I think, the fact that you're taking your behaviors away, your bad behaviors away, and the fact that it's diversification leads to Angel and VC in general being a great asset class. And so the studies around where you allocate your portfolio once you have enough money is usually sort of three buckets, right? One bucket is sort of emergency money, 3 to 6 months. I mean, I'm not a financial advisor, but you can read the press that gets there. And then there's the stay rich money, which is the bulk of your portfolio, and that's the traditional asset class, equities, international, bonds, all those things. And then there's sort of the get rich bucket, which is money you're fine losing. It's not going to change your life if you lose that money, but actually a great return on that money could really sort of make you rich. And so from that standpoint, if you read a bunch of books around this, it's usually 10-15% for wealthy people. And in that, angel investing actually plays a big role, or can play a big role.
So one thing to consider, though, if you want to do this and do it properly, it takes a lot of time. Deal sourcing is not something that just happens, right? Of course, you all have a few friends in the Valley or elsewhere who will contact you, say, hey, I've got this great new company. That's not deal sourcing. That's a few deals. If you want to do deal sourcing properly, you should do a lot of networking, go to or join angel clubs like the Wharton Alumni Club, attend business plan competitions, attend pitch days, even get to know these companies before. There's a lot to be done. Once you have a lot of good deal flow, you start understanding what good deals are and screening and getting to the right ones. Then you need to get into the deals. You need to negotiate these deals. You need to close them. And that's only the beginning. Once you're in the companies, you need to track what's happening. Otherwise, there's a melting ice cube phenomenon. If you're not managing something actively, if you don't know what's happening there, if you don't know when you should probably reinvest or not. And that takes time to develop. You need to understand the company well. You need to understand the situation it might be in. You need to understand how the management acts and reacts to situations, so have a good perception when the question pops up. When you need to answer that call within a week or so, you need to be equipped to do it. Otherwise, you won't do it well. So to make a long story short, especially if you do multiple investments, which is what we would advise, you need a lot of time. So if you're not able to invest that time, it's a tough asset class to be in.
And, you know, you invest your money, you invest a lot of your time, but you also need to be comfortable with the type of risk you're going to take. And I think that's a little bit of a mental shift for a lot of people because, yes, the stock market can tank, but your value is still not zero. If you invest in a startup early stage, and actually we'll talk about late stage about the same, 50% of what you're going to invest is going to go down to pretty much zero or at least have a strong negative return. And so that's something you need to be aware of. And that's why you need to, as we're going to talk about, build a portfolio because any single bet, I mean, again, like me doing a couple of deals for my friends was like money that I was counting as zero anyways. But if you're doing this as a professional investor or semi-professional investors, you need to think about those risk returns. And so the only way you're going to have to do this is to realize that 50% of your portfolio companies are going to die. And that's just okay. That's actually completely on par with the industry. Essentially what you're shooting for is the few in your portfolio that are going to make 10, 20 plus X. And that's basically going to pay for your entire portfolio. But you need to, in many ways, go broad enough that you can actually capture a few of those in your portfolio, or that you have the right chances of doing so. And if we look at the next slide, it's a similar type of data. It's the return from sort of venture firms. And there again, like more than 50% of the firms don't return the money. So get in your mindset that this will happen. There's actually really no way of predicting it. Although I'm talking to an AI company that predicts apparently returns of startups. I'm a little curious about that. But the reality is, if you talk to any investors, like there's a way to separate a lot of companies that you think are going to fail. But I don't think if we were to take a bet right now and say which ones in our portfolio are going to fail, we'd probably be wrong, right? Last year, there's a company that I personally thought was not going to perform all that well, and last quarterly update we had with them, they were doing amazing. And on the other side, there's companies that I thought were going to do really well, and they're struggling a little bit more. We still haven't had anybody sort of go under, but we've had a couple near misses. But yeah, exactly. But we're aware that that's coming.
Good. So what are the key success factors, right? And Ben just alluded to the most important one, but diversification. If you walk away from today's presentation with one idea, is diversification. If you invest in less than 20 companies or so over a few years, you're not diversifying enough. You're not getting a shot at getting the outsized returns. I mean, if you get it, all the better for you because you lost less money on other deals, but most likely you won't. The next thing, of course, is it's all good to diversify, but you need to get into the right deals, right? And to do that, you need to develop your own deal flow channel. You need to start to get to know people. You need not only to see deals, but very often to be able to see deals before they reach other investors, because that way it gives you more time to do due diligence and do your screening well. It gives you more time to get to know the entrepreneur and develop a relationship such that even if you don't have legal rights to reinvest in the future or whatever, you'll probably get invited. It gives you an ability also sometimes to negotiate better terms. Take all the companies that do the YC demo day, for instance. If you get in them 2 months or 3 months before, you get better terms than if you get into them after demo day. Is the risk profile significantly different? Not really, a little bit perhaps, but you're certainly making a better deal. So you really need to find your angles and develop them over time. The other thing, and here a statistic is pretty compelling, is how much better you do if you do your due diligence well and your discipline as to how you make your decisions to invest or not. People who spend 40 hours or more in due diligence basically do 5 to 6 times better than other people, and that's a staggering difference. You would hope there would be statistics like this for your children when you tell them to do their homework. That'd be very helpful. So that's another one, and then one that people think about less is actively supporting your portfolio companies, right? When startups are young, the impact you can have just by a few actions, by leveraging your network a little bit, by helping them on a topic you know something about, is huge, or even just by listening to the entrepreneur and helping him, being a sounding board, helping him think through things. The reason is those young companies, they're cash-strapped, and the entrepreneurs are really time-strapped. Anything you do to give them a bit more cash, for instance, by connecting them to investors you know, or to spare some of their time, can have dramatic effects down the road. It's a lot more rewarding than working in a big corporation and feeling, okay, I've worked all year and I've shifted things like this. Here, you can work for a few hours and shift more in the future of that company. So it's pretty exciting. It's one of the things that gets us going every day. If you start in this realm of angel investing, obviously try to start with things you understand. So try to find investments in your own industry. You shouldn't limit it to that over time, but as a starting point, it's a good thing, because if you're learning both an industry and the company, and at the same time how to do angel investing, it's a lot to do at the same time. So if you do your first few investments in something you understand, it allows you to free up your mind to really think more about the mechanics of investing and how you're doing these things. And I'd like to finish this slide again with diversification, right? I hope to bore you with this by the end of it. Yep. Yes.
Can you go into more detail about what you look for when you are doing due diligence, especially if it's for, a company that might not have P&L streams, or a lot of their work is in the idea and maybe the execution?
Yeah.
Should you give money to them? So we can go into what you're looking for when you're doing due diligence?
So there's a number of things you look for, but if you try to boil it down to the essential ones, the first one is the team. Do you believe in the team? Do you think they can execute what they promise to execute? And even if the team is not complete, do you believe that the CEO, the founder or founders are charismatic and strong enough that they will attract good people around them to make that happen? One of the things you can observe is the velocity at which they've been executing so far. So everybody always focuses on the future, but actually ask a few questions about the past. And what you'll learn is how fast they're going, how they're reacting to difficulties, and importantly as well, in the way they describe it to you, how earnest they'll be in communication with you and with other investors, which is a huge positive if they are, and not so great if they aren't, right? The next thing is the market opportunity, right? And so of course there's the size, you want a big market, you want room to grow and so on, but you also want to understand that they're really disrupting something and that they have a shot at becoming big. In other words, every time I look at something, I'm wondering, should I really look at this? I ask myself, is this a feature to a product? Is this a product, or is this actually a company? The first two are not good enough. If it's a company, then you should go. And I see entrepreneurs smiling in the room, so they know what I'm talking about.
The one thing, and we're putting together sort of a more detailed sheet for the Wharton Angel network, even to just like grade very early deals that are coming in, but I think the same theme come through. The two things that I've learned, like sort of in the last year, that have resonated a lot, in addition to the team, is it's a little bit overused, but I actually now understand it, which is different, which is this aspirin or is this vitamin? And I usually do diligence, want to talk to some customers because I really want to understand, are they solving something that's really a big pain for the potential customers? Or is it a nice, like, incremental something? And the reason is, well, A, if it's real pain, you potentially have a bigger market, or you have to establish a market, but it's potentially a bigger market. B, a startup doesn't have the cash to wait for a 6-month sales cycle. And so if it is a pain, people will put money down. They will give you money up front to do a proof of concept. And so that also gets the startup going. And so, a little bit of this idea of, are they solving something that when you talk to the customers, you're like, oh, yes, that it really is a game changer, or like, yeah, it was a nice feature, I tried it, but it wasn't really sort of game changer. And the other thing we sort of ask ourselves in our sort of weekly calls is, what's the story to 10x? Do you see a story where if you execute properly, you get to a 10x return, right? Because again, we know that 50% of them are going to fail. And so do you get to 10x? Is there a mental picture? And that's where you start talking about valuation. Somebody who's been in that business also for a very long time said this to me, which is sort of also sort of cliche, but it's, you make your money when you buy the company, right? You have the right terms, you have the right protections, you have the right valuation. And there's a lot of craze around doing deals, but if you do a deal that's way too high in terms of valuation, well, what's that path to 10x, right? And 10x is a big multiplier, but it's what you're shooting for. And so 10 million or 20 million up front is a very different outcome in terms of what you're looking for. And so are companies being bought at that price or things like that? Yeah.
When you say 10x, over what time frame do you typically try to realize that?
I'd say you aim for 7 to 8 years. You hope some of them will be a lot quicker, but you just know this is a very liquid market asset class, right? So you shouldn't be too ambitious on the timeline, otherwise you're up for disappointment.
But I mean, we just had this example. We were looking at a company yesterday, and they're at 8 million valuation, and we're thinking about, in this sector, can you see something like that happening? Why would it happen? Well, it happens potentially because those big players are looking for an answer. And so you're hoping for a quicker 10x, but is there a path, and are there deals in that environment that actually make sense at this price? And for some industries, the answer is yes, and some industries, the answer is if you're investing in something at 20 million, you don't see, like an exit at 200 million is really, really hard.
Yeah, most exits are between 50 and 100 when they're successful already. So what are the main hurdles to achieving the key success factors we've just seen, right? Two things. First of all, you often end up having limited diversification. Why is it? Because it's all good to say, hey, you should diversify. But the truth is, to enter into some companies, you've got minimum investment tickets. If you want to invest in at least 20 companies, well, multiply that by 20. It's a pretty substantial amount, right? So that can be an issue. Another one is time constraints. A lot of people get into angel investing thinking, yeah, I'll do angel investments. I'm going to do a lot of them, and then just don't have the time, and life happens, and God knows what else. And before you know it, hey, you've been doing this for 2 years, but you've got 3 deals. You're far from diversified. 2 of these are already failing. You don't know what the third is going to be doing, and you're starting to be a bit nervous about it. And there, the kind of stock market reflexes creep back in. You're like, well, maybe I should drop the whole thing together. And well, okay, you've lost 3 investments, done. That's not what you're going in for, I suppose, right? And the other thing is when you don't have enough time, it's not just that you don't have enough time to do enough deals and diversify, you don't have enough time to maximize your returns, right? You're not selective enough on the deals you do. You're not helping the companies the way you could and should. You're not tracking them properly enough to actually know when you should reinvest or not. When you get that call from the operator saying, hey, I'm short on cash, I'm raising another $1 million, are you in for your pro rata? And you just have absolutely no clue where you are. So that's the main hurdle, right? If you need time, you need money, and you don't always have all of it.
When you're first starting out, let's say you have 0 investments, how many would you say you need to diversify?
I think 20 is a minimum for that. If you look at a lot of studies, they tell you should actually get to 40, which is a pretty high hurdle. But I think at 20, if you do your job well, you should be all right. It's a good enough start.
So yeah, I mean, it's obviously you're not going to do that in your first month, but you should commit to doing 20 deals. So the idea is take that 10 to 15% of get rich money, how much you want for Angel, divide that by 20, and it gives you an idea for how much you're going to invest in those companies over the next 3 years, something like that.
And very importantly, when you make that calculation, don't just make a calculation on the upfront investment, right? Factor in reserves to reinvest in the future. We'll talk more about that later, but whether a company goes up or down, you might need those reserves to maximize your portfolio. So how do you overcome these hurdles of time and money? Well, the obvious answer is to join groups, right? John, and a lot more credit to him than to us for starting the Wharton Alumni Angels of Silicon Valley, created this group. The whole idea is if you get together, you pool your resources, you can put smaller tickets as an individual in each company. You can leverage your expertise for other people and their expertise for your own purposes. You can do less work, all the while doing good screening. You can have a broader amount of deals come to you through that funnel. It shouldn't be an exclusive funnel, but it's, I all encourage you to join the organization. That would really help you. And so the other truth is you should commit to the asset class, right? As we said before, if you are going to panic in a couple of years and stop, you're going to lose money. If you want to do it properly, you should know it's a commitment. And the reason why we put the wedding picture up there is it's a commitment that your spouse should also feel comfortable with. Otherwise, you will run into different issues, and that might also derail you in a number of ways. And of course, the next question is how to do it.
Yeah, just coming back on this one, the spouse question is important, right? I talk about deals with my wife, who's humoring me, but she knows what's going on. And a very good friend of mine was now an investor in our fund. I mean, I know his wife, and we talked about it also. She was totally part of the conversation, even though it's more of a passive way of doing this. it's important. I mean, it is a chunk of money and it's a chunk of your time, and so having that sort of understanding is going to be making your life a little bit easier as you type up your notes at 10 p.m. because you just had an interesting meeting. The other thing about the group is this is our experience as well, right? We've actually leveraged the Wharton Angel Network. I can't say the full name, sorry. But for a deal recently, and we were going in saying it's this whole question of areas of expertise, right? It's a deal in sort of med tech company, sort of device company, and the deal looked good. They had some patents. They were getting some traction with investors, and we didn't know enough about the industry. And so it's like, oh, it looks good, but we need to learn more. And we've actually extensively used the network through the Wharton Alumni Angels of Silicon Valley, and actually got to a no. And the no was because once we actually met a couple of people that really understood the company, or sorry, the space, we weren't worried so much about the company itself. We were worried about how much time and how much approvals it was going to take to actually get to money, and so by that time would be completely diluted. My first fear going in was like, oh, the technology is not going to work or something like that. Turns out that wasn't the problem, but there still was another problem that we wouldn't have really grasped if it weren't for access to the network. Cool, so I mean, anyways, in many ways, like you have a lot of options for how to do this, and this is a little bit my journey, as I was saying earlier, sort of 2 or 3 years ago, I started scratching my head about this, right? And in many ways, I went through all those steps, right? So you're doing it alone, and frankly, that's not fun. I mean, I said the fun factor, it's fun to talk to people, but you're really doing it to help a few friends at that point. But you get the sort of strong sentiment that you're putting money in the trash and just lighting it on fire. You don't really know what's going on. There are a bunch of people who are, at that point, way more experienced and can do it alone, obviously. But it's still from a time commitment, also having the ability to have a soundboard and sort of test your thesis around, well, what are the risks we're taking? Is this a 10x company? All those questions. It's much harder to do it alone, and so I think you can do it alone, but you need a lot of experience before you get there. Otherwise, you're going to do 3 companies and find this overwhelming and sort of quit. The next sort of step that a lot of people think about, and I got sort of clickbaited into training about angels, that it basically is a big funnel for angel list. So I learned a few things, and then I was scratching my head about angel list. And that's interesting, right? You can do a lot of deals. You don't really have to do all that much work. You can sort of spray and pray, as it's usually called. Like, oh, you put $1,000 into 100 companies, something will happen, maybe. The one thing I uncovered later on is, well, there's a bit of a problem in general with how you do with all the sort of crowdsourced investment is they don't actively manage the money. And so you do a check for one round, and then you sort of pray that something good is going to happen. But the reality is unless you invest in like Google early on, that's been pretty much a linear story. Most stories aren't like that. And so there's going to be questions at some point where you actually have rights to exercise. You need to know what's going on. Are you going to put pro rata money not to get crushed in the cap table? And those things are never managed. I was asking the same question. I asked the same question basically to all of the platforms, AngelList, Funders Fund, a bunch of others, and they don't actively manage. And that's an issue for you because, as we were saying earlier, a lot of the benefits and the returns actually come from this momentum and doubling down and reinvesting in a bunch of companies. You can't do that with the platforms. So it's a good way to get a lot of good deals. It gets more interesting, but play with it. Don't consider this as serious angel investment if you want. Then, I mean, our answer first off was to create a fund because we, like, in large part, had David, who has a lot of experience in the field, and then we were already getting a few friends around that. And I think that's it already gets you to the group answer, which is, well, you're getting multiple people, you're getting access to different networks. You can now start bringing value to those entrepreneurs that you're investing in as well because somebody in your group knows somebody that knows something about medtech, and that's going to be valuable for your entrepreneurs. And so that's, I think it's also a very good idea to manage the volume, right? If you want to do 20 deals and just the portfolio management alone of knowing what's going on in 20 companies at the same time, in addition to your day job, it's hard. And so if you can share that with a group or share that with some friends, that makes it a lot more manageable. And then, I think Angel Network and the Wharton one is definitely a strong option, right? Because there is going to be already pre-screening of deals. So you don't have to do a lot of the upfront part of the work. And then the way it's going to be structured, and maybe John can talk more about this, we're going to offer the ability to sort of do group investments and while negotiating those rights that we were talking about. And so you can commit, the ticket doesn't have to be big, so you can reach your diversification levels, and all this with sort of a, don't worry too much about the first part. You're still as a group going to figure out how to manage a deal going forward. But if there are 10 fellows, Wharton alumni, investing in a company, that's going to be a lot more manageable across a portfolio. So that's our sort of pitch to you here, which is John is here, and so we're open for sign-ups.
Yeah, for sure. So getting maybe a little bit more into the nitty-gritty, and you can ask a lot more questions about these things in Q&A if you'd like to. We often get those. What do you need to do when you negotiate terms to make sure your investments are going to be successful? There are a number of things you can do, but there are 4 that I think are really, really critical. The first one is valuation. Everybody thinks about it. Everybody knows it. Ben mentioned it earlier, but if you're not disciplined across your portfolio when you make investments, say you're only going to end up shooting for 5x on your companies instead of 10x. Well, guess what? With the failure rate, your portfolio returns are going to look a lot worse. Even some of your companies make money, you're like, hey, I did 5x on this one. It's not that bad. No, per se, it's not. But as one of the only winners within the portfolio, that's a problem, right? So you need to be disciplined about that. And everybody thinks about it. And so whether it's the valuation and equity round or the cap and the discount in a convertible note or a SAFE or a KISS, whatever equivalent, everybody thinks about it. What people don't quite think about is what happened in downside scenarios, right? And one of the things when you invest in convertible notes or equivalent instruments is that there's a case which doesn't happen very often, but when it happens, you don't want to be hurt by it, which is where the company actually gets sold before it does an equity round. Typically, that sale won't be for a great valuation, but it can be decent. It could yield you an okay return. But if you haven't secured a term whereby you get at least, say, twice your money back, and not just your money back or the conversion into equity at whatever valuation would have been for the round at the cap, whatever, you end up getting maybe only the interest rate on the money, if there was interest rate on the note. That's not why you're in the game for. It doesn't make any sense. So you want to negotiate this. Very few people think about it, actually, but it's something that's absolutely key. Entrepreneurs may not necessarily like it, but the ones who are earnest about wanting to do this in partnership with their investors and don't want to leave anybody in a bad position when there's an exit, we'll want to do this with you. The next thing, and that's very important, is information rights. We mentioned earlier, you should track your companies, know what's happening. Well, it's great to chat with the entrepreneur once in a while. If they have time, often they do, but not always. But what's bad is if you do it always without any numbers. And so you want to make sure you receive quarterly updates, just the financials, as other investors would. Now, typically, these things are not in a standard SAFE or KISS, for instance, which are the forms from YC and 500 startups. But you can easily get side letters from the entrepreneurs. I mean, they're producing this material for larger investors anyway, and so if you have a good relationship, you can get it. And you want to make sure it's a right that survives after your instrument converts into equity. Because very often, it's written there. Great, as long as I hold this note, I get the reporting. But once you've converted into equity, there's the new rule imposed by Series A investor. Any major investor, quote unquote, i.e. investors who have invested, for instance, $250,000 or more, or have X shares at least, will get updates. The others don't get anything. So you don't want to be in that boat. And in the same way, the same thing happens with pro rata investment rights. Ben mentioned it earlier. Your success at a portfolio level will depend on your ability to reinvest in the winners. It also, in difficult cases, when you have pay-to-play financings, which are financings where you can lose your economic rights, notably your liquidation preferences, your ability to invest then and make sure that you protect your economic rights and maybe benefit from the round that has maybe a 2 to 3 times senior preference off the top. Entrepreneurs hate to hear this, but in the companies that go down a difficult route, need to refinance internally and not everybody can step up, that's what happens. And if you still think the company will survive and get to an exit, even if it's just a semi-decent exit, you can actually still make a return on that investment. Even if the overall result for the company is not great, you can still make maybe 2 to 3 times the money on your investment, which at a portfolio level, if you do this on enough companies, can shift your entire returns quite far to the right, and that's something you should want, right? So it's not just about the winners. Managing the core of the portfolio, managing the middle, if you can do it properly, also can make a decent difference.
Yeah, Just on information, right? I mean, it's amazing how many people do not exercise this, and we've had situations where we've asked for sort of basic documents, and we were getting pushback for, well, you're the only ones asking for this. We've uncovered mistakes in those documents, and then we're able to give it back to the entrepreneurs. And A, you're sort of proving your value, but also you get a feeling that you're doing something right. And it's you need to step up for those. That doesn't mean you're going to be a pain or want to be a pain. It's just, well, you're an investor, you're taking risk alongside the company. You should know those things. And so just from a portfolio management perspective, knowing what's going on, quarterly financials, when there is a equity round or conversion, just getting the basic math and cap table, that's part of the discipline. That is going to be key to your success, right? Because the math in that case was actually in our favor. We told the entrepreneur and they sort of went with it. It could have been not in our favor and everybody had signed the papers anyway, so.
Yeah, I was just gonna ask, you mentioned a lot about some of the advantages of being in a network, and then now here talking about key terms. How important is it when being a part of a network, the ability to actually syndicate within the network and write larger checks, as opposed to some networks still invest in individuals when they're trying to write checks? How much does that internal syndication help you negotiate these key terms?
There's a bit of a line in the sand that's actually defined in the KISS document from 500 Startup. In part, for example, in information right, they basically define in that template document sort of information right at investor who put a $50,000 check or more. But if you syndicate, $50,000 check is actually the sum of like a few of like $5, $2, $3, $10,000. And so then as a group, you can actually, you almost get grandfathered or you negotiate those rights very easily. As an individual, it gets a lot harder. I mean, it's hard to get in with $5,000 or $2,000 anyways, but reaching that sort of $50,000, there's a lot less pushback once you're sort of at that level from entrepreneurs on all of those points essentially.
And that's also why within the Wharton network, right? When we when we do deals, we have a deal lead, somebody who spearheads, as you know, John, and takes care of that and does all the negotiation. But if that person has questions, has not negotiated specific deal terms, then we can call on anybody else in the network who has done that, or if needed, we can talk to a lawyer, of course. But we can do a lot of it by ourselves, yeah.
Can you talk a little bit about the differences between angel investing as an individual versus investing as a group, meaning actually creating the group, vehicles, structures, et cetera, bringing together friends and family to actually create income?
There's a next slide that talks a little bit about that. That's a good question. Thank you.
It's not exactly this, but I think maybe we can cover this and then come to your question because they're related. This is sort of if you're looking at a vehicle in general, and so it's true whether you're creating the vehicle or if you're investing in a vehicle. But essentially, what are the key questions you should ask them or have in your group as you're creating this? And if you're investing in a fund, it's sort of the mirror question of a few of the points we were raising in the previous slide, which is, well, what is your reserve strategy, right? As we've said, a lot of the upside comes from momentum and riding the winners or being able to pay to play when there's sort of a turnaround or a pivot situation. What's your strategy as a fund? How much money are you setting aside? At the deal level, at the fund level, you may not get right answers, to be honest. And even if the answer is we write it across multiple funds, then the follow-on question is, well, how do you manage the potential conflicts of interest between fund, right? So if Fund 1 invests in a company and then Fund 3 does the follow-on, and then there's a pay-to-play, well, who's right are you protecting first? Fund 1, Fund 3, it may not be the same investors. It gets pretty messy. And so it's a very important question to ask upfront in terms of at a portfolio level. Key investment terms, I mean, we've just covered those, but essentially, right, what you get from an M&A, how the information rights, pro rata rights, all those things. And then sort of just general discipline. How do you get your funnel? Who are the companies you work with? Other funds you're friendly with? Are you part of networks? And then also, what's your quarterly or what's your portfolio management discipline, right? Okay, if I call you up, are you actually able to show me the cap table of all your companies? If you do, you're probably it's probably a 10th percentile fund actually in terms of their discipline around this. So it's incredible how actually sort of basic stuff is actually already sort of outstanding in many ways. And so if you're thinking to invest in at the fund level, that's really sort of the same questions. And some of those questions then come through when you do the when you create your own structure, if you want.
Right, and then you've got the whole legal setup, which is a bit of a pain, but Wilsons and Senior is a good group, for instance, to help you with things like that. Others do too, but yes. No, it's a pain, and you should do it well. These are when you haven't used those type of partnerships before, these are not completely obvious structures, and you don't understand all of the mechanisms urgently. It's better to spend a bit more time with your lawyers and make sure you understand everything. Spend a few more $1,000s, but make sure you know what's happening, you know what your duties are to your investors, you know how you need to report to them, etc. It's better to do it well, slower, than shoot yourself in the foot going down the road.
Yep. So a question. Generally, are fee structures for angel funds similar to institutional Series A type fees, or like how do those angel funds work?
Most angel funds work on a 2 and 20 basis. When we set up our firm, we went at it differently. We said we would not charge management fees, only carry interest to be fully aligned with our investors. I don't think everybody does that. Few people do it, but 2 and 20 is the standard model. You even have some cases where people take a bit more in terms of management fees, arguing that the fund is so small we can't function without it. That doesn't help your returns, of course.
And there are also sort of hidden fees, like in a lot of financial products. One thing I didn't mention about AngelList or crowdfunding is you usually, for example, set up an SPV for each one of their investments, and they charge you back that cost. They charge you back $8,000 over the life of a deal, and so depending on how many people actually fund that deal, it's a little bit of a pain. And so some funds, there's the 2 and 20, and then you have to figure out also, are there extra operating expenses that they're charging back to you or not?
Maybe just to follow on to that, talk a little bit about the difference with, for example, Wharton alumni agencies.
Sure. Yep.
Right. That's true. We're still setting it up, but the whole idea is to effectively create a special purpose vehicle in which there will be several investments. It's called a class LLC, and so for every company we invest in, we'll have a different class of shares, and people invest in that. And so we're going to spread the cost over a number of deals, which means that you really, percentage-wise, it doesn't become that important, right? And so we want to do that because it minimizes the cost. It's also going to be a great benefit when you want to receive a K1. And I said 1 K1, right? If you do several investments through that vehicle, you get 1 K1, not several ones. And so there'll be some kind of centralized management, and we'll try to cover our costs as we set this up on the side of the organization, but it's not something you're going to get charge a lot for or anything like that. And so before we get into the full Q&A session, we want to end up with a bit of a controversial statement, right? But we actually think that angel investing is something that can deliver not only superior returns, but actually at maybe a lower risk profile than even being in the stock market or being in some of the other asset classes. Of course, if you do it well, you diversify, et cetera, do everything we've talked about. But the reason is it's not immediately volatile. As Ben mentioned, you're not having knee-jerk reactions in your portfolio. It just sits there. And if you've done it well, if you've got good assets to begin with, if it's diversified enough, over time it will deliver those superior returns you saw at the beginning. And ultimately, if you do it, that's what you should be gunning for. And so now we'd like to open it up for questions. More questions, I should say.
So for the WA&AM, how do we get involved and how do you manage which people are invested, how do you provide reports to them and so on?
Well, I mean, getting involved is pretty easy. Just you can talk to any one of us, and do I need this? You can talk to any of the members. I don't think it's on. But and also go to our website, WhartonAlumniAngels.com, and there's a join or membership link there. You can link onto and then just fill out your information, and then that's pretty easy. We pay everything through, at least as far as up to the point of the investment vehicle is funded by our annual membership dues, which is $250 a year to join as an investor, or if you just want to participate in the educational sessions, that's $60 a year for an associate membership, and that gives you access to anything that's educational, which could involve, for example, if you wanted to apply to be a part of, say, the
a team doing investment screening, or you wanted to put together events or interact with entrepreneurs or do other things, you could do that also as an associate. You couldn't participate in our investments as an associate. And I think your other question is how do you provide information and things? We expect a very active membership. So we also have some strong level of commitment we want from the membership. We're looking for people who can contribute significant time, which even if you're not on one of the committees or doing very active direct work for the network, we would still expect maybe an hour or two a week of time doing other things for the network. And also we expect investor members to be making some form of investments on a regular basis. Now, we haven't really quantified that yet, but it's very important as an angel network to actually be making investments. So there's a lot of angel networks out there who have very bad reputations among entrepreneurs because for them it's just, hey, we want to see pitches and interact with entrepreneurs, and this is a lot of fun, and we get together and we have some drinks, and then nobody ever writes any checks. And so we're very cognizant of that being not wasting the time of entrepreneurs, because that is not useful for anybody. And I'm not sure, did I answer your question there at all?
Yeah, and I
okay. Okay, and for sure we can spend some more time on that. I can give you some more information as well.
But just to advertise it, the key event that's coming up is June 1st, where we're doing sort of our first big pitch day, and so that's where we've curated a number of companies that will come and make a presentation about 10-minute pitch, 10-minute Q&A, and what we expect at that point is a number of people to raise their hands then and there to sort of form a first interest group to then continue the conversation with those specific entrepreneurs, and that's where then we're going to help on the side set up sort of the investment structure. So that flow is already ongoing, and so June 1st, you can come ready to make investments.
Just following on to that, is this a co-invest structure where you invest deal by deal, or are you investing in the fund and then you're
No, it's a deal by deal thing, right? And when we describe the DSPV will set up a class LLC, you invest in a specific class to do a specific deal, you don't have to invest in the others. We haven't quite defined that yet.
Yeah, we haven't quite defined that yet, but I think that as in the investor, there's going to be some breakpoint below which it doesn't really make sense because the fees are going to overwhelm your investment.
But I think back to this idea of $50,000, I think the goal is to get, for each company that gets investment from us as a group, is to get enough investors to represent $50,000. It's probably a good goal just from being able to negotiate those terms we were talking about.
That's a minimum as an aggregate for a deal. We haven't defined the exact bar, but yeah, that would be the bare minimum.
So could you describe, that was a great entree to that's part of my question as well, the internal workings of the network. For example, you said like diversification, so you can pick, an investor can pick which deals they want in, which deals they don't want in, so I'm hearing, and the investor goes to the different meetings to learn enough information to their own individual due diligence, or are they relying on a team doing due diligence in the
So you rely on the team to start the process, and if you sign up, you're going to have access to this tool called Proceeder, where you basically can see the deals and the different phases. You can actually ask questions and comment. Essentially, there's an investment committee that screens a whole lot of deals, get input from the community, and decides on sort of 6 companies to come to pitch day. At that point, they've been somewhat vetted, but we haven't done full due diligence. We haven't done deal term negotiations. The idea is you come to pitch day, I pitch, you're interested in investing in my company, thank you very much. And David from the Wharton Angels is the deal lead, so he's going to essentially collect all the intents of interests, and then you guys sort of go off on your own to finalize due diligence and do the negotiation and finally close the deal. At that point, you do it, if you want, within the structure we've defined so that it's just easier from sort of a legal and admin perspective, and you're now an investor in the company. But the whole point is we're doing curation all the way to pitch day. We're setting up the structure whereby people can invest separately, and we also name deal leads who act as coordinator for the investor groups, but then you still have to finalize, coordinate your own due diligence, and ultimately take a decision on deal-by-deal basis.
And the expectation is, right, if you haven't done this before, that in the beginning you're not going to be a deal lead, but you're going to learn. Maybe you attend a few more of these type of educational sessions, and as you start getting more confident, once there's a deal you source and or you have specific knowledge, and then you take that position. You can still lean on the rest of the network if you have questions, but we hope over time everybody will become a deal lead in one deal or another.
And maybe
sorry, you weren't done?
Well, so the company that is being invested in, the startup, do they see the network as their investor, or do they see the 5 or 6 people behind it as 5 or 6 different individual investors?
So they'll see the deal lead. They might see others depending on how the due diligence goes. But on their cap table, ideally, they will see one entity, which is that SPV. Right.
And that's an important note there, is that as an investor in the network, you will own shares in the SPV, which then owns either the note or the shares in the actual company.
What about the fall in that scenario where the SPV that makes the investment? Talk about a whole bunch of things about following up with the company, making sure that you communicate with all this stuff that.
So the deal lead will have that responsibility effectively. And so there's the follow-up, and then there's a question of the follow-on investment, right? Which, when that comes, people will need to answer and step up. The expectation is hopefully they would. I think it's going to be the deal lead's responsibility to make sure that everybody understands that when you do this deal, you should have reserved X% on top to make sure you can follow on in the future, and you can think about and discuss scenarios and think about what makes sense. The reality may be entirely different, but I think you should at least start with an ingoing idea as to how much you should put in. And we haven't yet set up structures. I cannot tell you what it is yet, but there will be rules such that, for instance, if there's a pay-to-play financing and some people step up, others don't, and the people who step up actually protect everybody by putting in even more capital, and they save everybody's liquidation preference, there's going to be some kind of redistribution of economic value. We just don't know exactly what the rules will look like, and that's something we'll need legal input in, actually.
But maybe we've talked about reserves a lot, but just to quantify it a little bit, and that's our answer. I mean, everybody can have a different answer, but the way we do it is when we make an investment, we sort of reserve within our own pool of money at the same amount for follow-ons, and then we have reserves at the fund level of another 20%, right? And so you're basically saying, oh, I invest 50K, I sort of mentally, I've blocked those other 50K, so I'm not going to invest it. So it's part of, when you're doing your math of like, okay, what's the 10% get rich? How much of that goes to angel? Divide by 20 companies, divide by 2 or a little bit more to actually say, okay, well, that's my check size. Because 2x that investment plus in your portfolio you should have reserves for the breakaways winners that you want to keep doubling down on. And so just to, I don't think there's a correct or there's a sort of academic answer to the reserves, but that's our sort of pragmatic answer for how we're managing this. And just I wanted to share that just so that it gives you a good sense of how much money to mentally put aside.
In other words, diversification, diversification,
Sorry,
diversification.
can you just repeat how much do you recommend leaving the reserve?
So if how is the math going to work? So say you want to invest $1 million, essentially keep 20% overall, not dedicated to a specific company at this point. So let's make the math simple. So 800, and then you want to invest in at least 20 companies. So say you're set on 20 companies. So divide by 20. That's going to be $40,000. And then we're saying first check should be half of that, and keep the other 20. So you invest 20, you keep the other 20 sort of aligned with this company until either the company goes down or you reinvest that money, and then you still have sort of fund or portfolio level reserves for following on further with.
And the important thing to keep in mind, right, is that as some companies fail or do successfully, you can either invest that much. The amount that was allocated to them gets reallocated to the free pool, right? It's not as if, oh, hey, it freed up, I'm going to put it elsewhere. That's embedded in our calculations.
Hi, I have kind of a two-part question, so bear with me. It's about some basic information. Earlier in the deck, you said illiquidity is your friend. Can you please explain a bit more what you meant by that? And secondly, many startups, bootstrap startups, do convertible note financing. How much could a startup say about pre-money valuations if it's convertible note financing, or can they only talk about the cap? How much can they legally say talking with investors about valuation?
I'll turn the question to her, but what I can tell you, there's the cap and there's the discount. Typically, if exact part of terms, if you convert it, 20% discount, that would be the standard, and a maximum of X, which is your cap. We've had a lot of companies tell us that, hey, we're already talking to investors for Series A, and it will be twice that. Are they allowed to do it? I assume so. These are private companies, but Herb, please correct me if I don't get this right.
You're talking to, assuming you're sophisticated investors, there's no limits in what you can say to them, but you are held to the standard that it needs to be true.
So no fraud, basically.
Weird concept.
And to your question, and to your first question, illiquidity or a friend, I mean, the whole idea is you're not going to be put in a position where you can have a knee-jerk reaction, right? Somebody bombs Syria for some reason, and suddenly, hey, stock market would be crashing or not, go figure. But stock market would be crashing, and you're going to sell your stock because you panic. You're not going to be in a position to do that, right? And so it's your friend because you keep on a steady long-term strategy. There's no event today or tomorrow in principle that would change any of that.
It's the whole Warren Buffett thing where he says, well, I'm comfortable in my companies that if the stock market was shut down for 5 years, I don't really care. Well, that's actually a reality. The stock market is shut down for 5 years. You can reinvest at time, so it's maybe shut down for like 18 months at a time. But that's what it is. And if you look at, there's this interesting study from AAII, the American Association of Individual Investors, and they poll their audience investors, like I'm part of it, whether they're bearish or bullish. The worst time people were all in cash, they were like the market is going to crash, March 9th, 2009. Like the actual week of the end of the bear market is when everybody was saying, I am not putting $1 in the stock market, right? And here the question doesn't happen because, well, this is what it is, and then you're sort of having to write it. So illiquidity is your friend from a behavioral standpoint.
Illiquidity is one thing, but eventual exit strategy is another. So are you just waiting for for an IPO or for a buyout, or are there other exit strategies? How does that all work?
There are. So that's a very excellent question, right? That's part of why you should be tracking your companies closely, right? In many cases, you won't have control, right? There will be the eventual IPO or more likely a buyout of the company. But in some cases, and the companies are successful, there's a whole secondary market that exists, right? There's platforms like SharesPost, Second Market, et cetera. There's brokers. There's a number of things like this. And if you know the company well, if you think, like many of the unicorns today, is it's completely overpriced and you're wondering what to do with it, actually, why not sell it on a secondary basis? Maybe you won't get the 100x you might have had if there was an IPO that was really successful, but hey, you're only making 20 to 30x now. It covers your portfolio. You're in the money. Maybe you've been a bit more conservative, but chances are that was actually the right choice. So yes, be proactive about exits too. It's an excellent point.
It's actually a very important question to have, discussion to have with the entrepreneurs. And I mean, the answer is like, oftentimes the answer is, well, IPO, most likely M&A, that's fine. But there is this sort of part of the market that's actually really good for diversification. That's more angel focused or Series A, which is, well, actually, if we succeed, we became a bit of a rent business. And one of the companies we just invested in, there's like 50% chance they get acquired, like if they're successful, right? So the 10x scenario goes well, they get acquired by sort of these other companies, somewhat identified, great. But frankly, they may not need that. Because if they're successful, it's just going to be a cash machine. And if you're a VC, like that's harder because you want that sort of end of period. But for us, I'm like, well, if you get 20% of your money every year, like keep going, right? And so that's also an important question that happens at some specific type of companies, but is where angels actually can have a very different outlook as to this is actually good versus others because it's good for your returns on your portfolio. You get cash out of your portfolio all the time. It can be a pretty interesting type of asset.
So just to follow on there, for those self-sustaining businesses that are throwing off rent money, as you say, is there a structure in which to do that to angel investors, like dividends on equity, or what's the typical structure for doing that?
You start the same way, convert to equity at some point, so hopefully they do a Series A, or you have in your docs like a period of time at which if nothing has happened, your convertible notes actually convert. And then you basically get, it's almost like you have a preferred share in the business that's generating money or investing in a REIT or something.
Thanks.
How does the Wharton Angel Investor Network relate to the off-the-grid capital ventures? How does that, are those competing interests for you, or those complementary?
For us, it's not that.
I mean, the two are completely separate, to be clear, right? And one of the reasons for us to help the network and so on is because we believe that it's an exciting community to be a part of. We're already a part of it, of course, and we think it's going to help some of our companies to raise more financing. We think it's going to be a great source of deal flow for us, right? And that's why we joined, and we're supporting and promoting it.
You may have already said this, but I was wondering about legal counsel as far as the work that you're alumni. Is the legal counsel part of your fees, or are you expected to get your own legal counsel, or what is it? Or when you're looking at the final term sheet?
So do you have an answer? I mean, when I'm a deal lead, I know I'm sorry, Herb, but I don't need one, but it's a fair question.
Yeah, I mean, we are not providing say a formal legal counsel as part of the membership dues. Everybody would be responsible for if they need legal counsel for making their own individual investments. We do have some legal counsel for helping us set up the special purpose vehicles and things of that nature, and they're directly related to the investment process within the network. But if you need some specific legal counsel related to your own individual investment, that's not something that we're providing.
The idea of the convertible note with a safe structure is you don't get a lot of lawyers involved. I mean, it's to keep it cheap. It's a leap of faith kind of on both sides. That said, you need to have the level of knowledge that some of these guys have as to what's normal, what the risks are, so practicing, being your own lawyer can have a lot of issues if you don't know what you're doing. So I've done it a while before, but still, the lawyer fees can't, or the size of these investments can't support lawyer fees.
A couple of things you can do, though, right? I mean, whenever you do a SAFE or a KISS, which is around 500 startups, even convertible notes, there's some standard documents online you can check, so you can compare both and see, okay, did they do anything different? And if so, you can start asking questions. And the other thing is, the Wharton network will serve as a resource. If you have questions, there's going to be people who probably have the answers in there, right? So the whole idea of being a group.
As an example, we've done review of SAFE, which is a pretty classic YC, like just look for SAFE convertible note, you're going to find it online. We have our own markup of that, and so clauses around investment information rights, around the M&A clause that's usually not there. I mean, we're going to share that with the network as, hey, here's the usual template, and here's like the things we usually negotiate, and here's sort of language that's already been vetted, and so that's, I think, a great starting point.
Yeah, and I think to that point that was made, if you start getting too many fees involved, it's for the size of investment, it's just not going to make a lot of sense. So there is a self-service aspect to that. That's actually one of the reasons why we became, the Wharton Angels became a part of the Angel Capital Association, which provides a lot of self-service information about angel investing. And so if you do join as a member, then you'll become a member of the Angel Capital Association, and you'll have access to all of their resources as well.
There's a couple also really good books covering angel in general, and there's a couple ones specifics to sort of term sheets and deal terms, so you can use that as well.
Yeah, if anybody's interested in getting some references on books or other sources, let us know and we can get that to you.
Please.
I guess I was just to add, I guess in the due diligence that I've done or the other angel initiatives that I've done, it's been helpful to also seek out some of the, lead investors. So if my experience, when I was part of Angel Network in New York, we might be one entity, but Harvard Angels is doing, their stuff, and they may have been more into the due diligence than we have, or a lot of startups are forthcoming with who are the leads, and then there becomes a broader dialogue, so you feel like you've gotten a fair amount of expertise involved.
With Venus last question, one question, two guys.
Well, maybe you get a 2-minute break to get coffee and reload before Herb takes over. Thank you very much. It's been a pleasure.